will be hot.
Here we go.
Welcome, everybody. We'll be getting started in another minute or two as people continue to file in. Good morning, good afternoon, and welcome to everybody on the phone listening to East Daily's Crude Edge Quarterly Market Update. My name is AJ O'Donnell. I'm a Director of Research here at East Daily. I'm joined by my colleague, Christine Olezek, who is Director of Analytics. Together, we head up East Daily's crude team. We run a lot of the models that we'll be talking about today and have developed a lot of the presentation that you will be walking you through. Before we get into it, I'd like to just start with a brief overview of East Daily, who we are, what we do. Primarily, we connect supply, demand, and profitability through our analysis of infrastructure data and market analytics. So we do that by focusing our analysis on three key areas: supply analytics, demand analytics, and commercial analytics. We use as much data as possible to provide benchmarks within these three areas, and then we focus on building relationships between this data that can identify anomalies, construct new data sets and models, and provide a more complete picture of a market dynamic. So the way that we provide value to our clients in their own analytic process is by reevaluating expectations and reforecasting at an asset level. We synchronize all three streams of energy production, NGLs, crude, gas, to align and catch market inconsistencies. We calibrate these fundamental outlooks with corporate commercial expectations, and we balance volume expectations tied between different infrastructure types and market segments. And the way that we deliver this data is either directly via a data feed, PDFs, presentations like we'll be going through today, models, or our Energy Data Studio platform, which is our BI platform, direct support from our analyst team, or through consulting engagements. The way we do this is we collect over 100 different sources of publicly available data, all the way up from the Canadian Energy Regulator down to regulators located along the Texas Gulf Coast. We scan SEC financials and corporate reporting, and we put all these data feeds into construct a concise data set construction that triangulates multiple data sets to fill large gaps in data. We use our proprietary modeling to assign a well to every single midstream system through North America. We also look at nodal market models. So what we'll be going through today, like the Crude Hub Model or the NGL model, that's a supply and demand balance, like hub and spoke pipeline flow model. And then we can also do commodity and profitability analytics. So commercial analytics and forecasting, our equity research coverage, and then cross-commodity sensitivity analysis. Before we get into it, I'd like to briefly just touch on the Crude Hub Model. A lot of the data that we're going to be going over today, a lot of the takeaways, the conclusions that we've come from, predominantly rose from our anchor product as far as our crude offering goes, which is our Crude Hub Model. The way that we go about creating this balanced supply and demand model is we first look at what is PDP production in North America from Canada all the way down to the producing regions in North America. We collect and aggregate all this supply data, and then we cross-reference it with what we see on pipeline flows. We also use for current rig counts to understand a benchmark for forecasting future activity. We correlate part of that with the forward curve just due to pricing, as well as align that with what producers are saying. So we use a handful of different data sources that we collect and aggregate into one data feed, and that includes FERC, the Texas Railroad Commission, the CER up in Canada, Sonras, and any company data reports. If you're interested in checking out the Crude Hub model, you can click on that link below and it will take you to our landing page. With that out of the way, I'd like to get into the thick of it. So we thought we would just start here, where don't look at the forward curve. You're not going to like what you see, and the forward curve is not meant to be a forecast. Instead, it's really a price that allows producers to de-risk their capital budgets and take volatility out of forward production estimates. So the title of today's webinar is 5 Reasons to Be Bullish and 1 Not to. And really the 1 not to is just the macroeconomic headwinds or fear of global recession or pullback in demand. That is really what's looming over the market as we see from being constructive to crude oil supply and demand fundamentals and price in general. But what we do see some structural reasons why that price will improve, especially in the medium to long term. And that has to do with demand growth, whether that's from the DOE's SPR repurchase program or growth from emerging international markets. It has to do with shrinking global supply and OPEC's production cuts, tight S&D balances that we're seeing in North America and worldwide, how exports in the United States are going to facilitate this growth and be able to quickly bring North American crude production into the international market to quickly fill that growing demand need. And then what's going to happen with Canada. This is probably the biggest thing that's happened in North American pipeline infrastructure from a crude perspective since we overbuilt the Permian beginning in 2019. So let's start with U.S. production. If you look in the top right graph, you can see our 22 to 27 exit crude production growth in the U.S. We have about 1.4, a little over 1.4 million barrels a day of growth over the 5-year period from 22 to 27. All of that is predominantly driven by what's going on in the Permian. We do have some volatility in our forecasts in our other basins, but those largely completely offset each other. If you look in the bottom right graph and you want to see how this aligns with maybe the EIA STIO, that red line or orange line in the top right, there's about a 200,000 barrel a day difference between where our forecast is and what this STIO is forecasting for exit 24. Now, part of that is due to our lower assumptions on rig activity due to backwardation in the forward curve, and then some upstream consolidation that we've seen. So M&A activity has been on a run for the last couple of years. 2023 has been no different. There's been 26 deals, I believe, with the Permian Resources Earthstone acquisition announced last week. And we wanted to look at basically how has the M&A consolidation activity affected our outlook or affected the outlook on forward production. Well, if you look in that top right graph is basically, that is the acquirer and acquiree rig count. So of the announced 25 deals or plus 25 deals, are they pulling back rigs as they said? A lot of these M&A deals have arose from, producers stressing capital discipline. As a result of that, they're pulled back rig programs and then have generally led to a higher payout ratio and a lower reinvestment ratio, which the data seems to back up. And now you're probably wondering why, if we're talking about, 5 reasons to be bullish, why are we talking about rig attrition? Well, part of that leads us into our first 2 bullet points. So one is demand growth, really from the SPR repurchase program and emerging international markets. And the other is tight S&D balances. So all this rig attrition that we've seen from M&A activity throughout 2023 and 2022 has led to historically low stocks of crude oil. Since 2020, we've also released about 300 million barrels from the SPR, which has added to this problem. If you look at the top left graph, you have days of supply, which excludes the SPR in that black line. That's typically the line that the EIA will use to reflect in their weekly report. What we've done is, we've looked at days of supply, including the SPR. And if you look at that way, you're at 50-year lows of where historically supply has been. Now, we've seen 2 large draws in the last weeks of EIA data, which has compounded the problem and pushed prices up even a little bit further. Now, as far as an incremental demand perspective, if you look at that right graph, the Department of Energy has started to repurchase barrels for the Strategic Petroleum Reserve. So far, they've awarded 6 million barrels of contracts. These contracts have started to flow into the SPR at the beginning of August, but they've said that they've desired to purchase up to 12 million. Well, the problem is that WTI has pushed above that 72 to 73 barrel threshold that they would like to purchase this oil, which has led them to effectively cancel the remaining contracts that they were hoping to award this year, which was another 6 million. So regardless, the way that we see it is that you have the DOE in here sitting as an incremental repurchaser of U.S. produced oil. This oil that goes into the SPR has to be U.S. produced. It can't come from Canada, and then it's not coming from from imports. It has to be U.S. produced. So the way that we see this really is that, you effectively have the DOE in there as a market, as a put, like a protective put in the market at 72 to 73. So if we see sour prices, which is the barrel that they're repurchasing, dip below the 75 area, we expect them to reopen their repurchase program or solicit for more bids. Now, it wouldn't be worth talking about U.S. balances if we didn't focus on the number 1 demand pull for U.S. North American supply, which is refineries. Now, the U.S. has lost about 700,000 barrels of refining capacity since January of 2020. That's come from closures and transitions to renewable fuels. This year, Exxon's Beaumont refinery was the last major refinery expansion that was planned. We added about 250,000 barrels of refining capacity there. However, any of the incremental demand that's associated from these refinery expansions is going to be relatively short-lived. We have the Lyondell Houston facility that will be transitioning, shutting down sometime in 2025. So bringing us back right to where we were before the Beaumont refinery expansion came on. So in all, that'll lead us to lose about 1 million barrels of refining capacity from January of 2020. So if we're not refining these barrels, where are they going? And I'll call your attention to the bottom right graph, which looks at excess supply versus exports. So excess supply is basically what your U.S. production is, plus what your imports are, minus your crude refining, gross inputs to crude refining. Whatever's left over is your excess supply. Now you can see since 2015, since the export ban has been lifted on U.S. oil, exports have grown exponentially, which has made the U.S. more important as far as the supply of oil into the global market. Now with that, I'll pass it over to Christy, who's going to talk about international.
Good morning. International. Do these barrels have a good market? Is it steady? Is it consistent? Do they want our barrels? The first thing that I wanted to talk about is global liquids demand. It is growing. It is growing through 2028, but it is growing at a decreasing rate, if that makes sense. So it's growing, but at a smaller rate. To back up just a minute, when I pulled this data, I was getting it from 3 sources: the IEA, the EIA, and OPEC. Now, one thing, all of the agencies agreed where we were in 2002. They basically mostly agreed where we'll be at in 2027. Where the discrepancy is in the middle. There's different paths on how we get from 2022 to 2027. But the U.S. is forecasted to supply the majority of the incremental barrel. Not the majority of global supply, but the majority of the incremental barrel. The largest supplier from 2027 to 2028. Now, when you look at the global market, it's been really interesting lately, especially since the Ukrainian war. To start with, Russia was supplying Europe with 2.5 million barrels of oil a day. Then they invaded Ukraine. And G7, Europe, the US sanctioned Russian oil. They did the oil embargo. But interestingly, when they did it, there was a lot of leeway from when it was announced to when it actually took place. Everyone was trying to avoid a global energy crisis or to really upset global supply and demand. So between the time that it was announced and it was put into place, Russia was able to find new markets for their barrel. So they went into India and China. So now 80% of Russia's oil is being exported into India and China. Interestingly enough, 45% of Russian exports are moved by pipeline via China and then from other markets from there. On the U.S. side, we've always supplied some oil to Canada, to Korea, to Japan, to the U.K., but we picked up the European market. We didn't lose any of our other markets, but we picked that up. When you look at the graphs on the right, you'll see that the Russian supply of that European market, they lost it almost completely. But they were able to get a strong foothold into the emerging markets of India and China. Now the U.S., we kept all of our markets, but we gained Europe. We haven't gained market share in India and China, but we haven't lost that market either. where is the oil going internationally? Where is the demand? So the pie chart on the left was 2022 end of year. The pie chart on the right is 2028 and how these markets are changing. What you're seeing is that the emerging economies are offsetting the contraction of advanced economies. The Asia-Pacific market is accounting for 90% of the growth from 2022 to 2027. And also, China has the most robust demand right now. 2023, 2024 are forecasted to be the largest growth for China. But in 2027, India will overtake China in the amount of incremental demand. Not total demand, but incremental demand. So the main demand pull for crude oil is going to be Asia Pacific. And you'll also see that North America, the light green, is contracting a little bit, slightly. The yellow, Europe, is also slightly contracting, but Asia Pacific is expanding. So the shrinking global supply. The one area that we haven't focused on much yet is OPEC. What's going on with OPEC? We have already seen OPEC cut their production in lieu of price. They're willing to take a reduction in market share for an increased price. And they're forecasted to stay pretty stable. It's a tight market, and OPEC is forecasted to grow, but not the lion's share. And you'll see with these red circles that the difference between OPEC and the OECD is changing. OPEC is going to be supplying less, the OECD will be supplying more by 2027. And then what's really of interest is just how tight these markets are. It's a very tight market.
Thanks, Christy. Now I'll take it back and we'll talk about exports and really how U.S. exports have become so vital to the global supply of crude. The supply of crude globally. As Christy called out, we do have exposure to those economies, those emerging markets that are forecasted to see the most growth over the next 5-year period. So if we're exposed to them, how do we get oil to that market? This is just a brief overview of the 3 primary locations that you can export crude oil out of the U.S. Gulf Coast. Starting from the bottom left is Corpus Christi, then Houston in the middle, and then you have Louisiana, which is a combination of Loop and a Chevron facility that is off just the coastal point of Louisiana right over there. You can see based on that pie chart, about 50% of what we're exporting, 4 million barrels, so 2 million barrels of that, more than 2 million barrels of that has been going out of Corpus Christi. Based on our Crude Hub model, we've tracked 4.5 million barrels being loaded onto water or being loaded onto the water at these locations. Roughly 4 million barrels are being exported internationally. That's based on the EIA data. So the balance between there is kind of probably what's going on Jones Act shippers in and around the coastal areas or barges in the intercoastal U.S. Now, the interesting thing about these locations does come down to how they source supply and also the capabilities that they're able to load here. So In Corpus Christi, that is the only supply point where you can get a clean Permian and Eagle Ford barrel. You can get Permian and Eagle Ford barrels into Houston and Louisiana as well, but they have a chance of mixing with other streams of production north of the Texas market, namely Western Canada, Bakken, Rockies, Anadarko, also what's coming in from the Gulf of Mexico. Louisiana is very similar to Houston in that way. Also, as far as Corpus Christi goes, excluding Loop, this is the only place that you can partially or fully load a VLCC, which has become important in today's shipping economics, where loading the most possible or the largest amount of possible crude at the lowest rate has become a determining factor in who's going to win these barrels. Another factor has been just the inclusion of these 11 facilities that are now included in Brent pricing. These are all predominantly included in, or predominantly originate out of Corpus Christi, though there are 3 facilities in the Houston area that are also capable of being included. Now, all these facilities have to meet spec, but it's evident by the flows that are from the comments that we've seen from some of these owners following the, their midstream earnings calls or for the second quarter, that these pipes are being able to meet spec as far as crude deliveries go. Now, Corpus Christi has been that preferred destination to export barrels out of, but we're running out of pipe space. So if you look in that top left graph, you have the 4 primary Permian to Corpus Christi pipelines that feed that shipping corridor. So that's Cactus 1 and 2, Epic, and Gray Oak. Now you can see that red line, which is the Port of Corpus Christi, that's reported by the Port of Corpus Christi, outbound crude oil shipments, correlates very highly with what these pipelines have been moving. Now, the problem is if you look at that right graph, because we're constrained on capacity, because these pipelines have been operating at 90% or above 90% utilization, we're somewhat limited on the growth that we can see from Corpus Christi docks as a whole. So if you look at that right graph, that blue shaded area is our forecast from our latest Crude Hub model of where we see Corpus Christi volumes topping out. Roughly, that's about 2.5 million barrels a day. And that's completely due to the limited pipeline capacity that's feeding Corpus Christi in the only area that production is growing, which is the Permian. So what that happens is that in order for us to balance our model, we start pushing those incremental barrels to the Houston market, which is represented by that orange area. Now, things could change here. Epic and Gray Oak do have the possibility to expand their pipes by a combined 500,000 barrels a day. Enbridge has been actively pursuing a 200,000 barrel a day expansion on their Gray Oak line, but nothing has been sanctioned. Epic is a very similar pipe and design characteristics as far compared to Gray Oak, but is not fully powered like Gray Oak is. So Epic can expand their pipe by another 300,000 barrels a day via pump expansions. That project is also not sanctioned. However, if these projects, one or both of these projects, come into the market in the next couple of years, we anticipate, volumes of Corpus Christi will steal a little bit of the growth that we have attributable to the Houston market right now. However, all of this could change with one or multiple of these SPM facilities coming online. So single port mooring facility, these are crude export facilities that are located offshore. They're predominantly capable of loading around 2 million barrels a day of crude oil. And the reason that makes these so attractive is that they face less ship traffic. You can also talk about shipping economics, which we touched on earlier, where it's cheaper to load a bigger ship. However, based on our outlook, we don't think both of these facilities will be needed, but we do see viability for one of them coming online. As far as who is in front of the line, it would be the Seaport offshore terminal, which is the spot terminal, which would be developed by developed by Enterprise jointly with Enbridge. That's a 2 million barrel a day facility. They received their record of decision earlier this year and expect to have a permit by year-end 23. However, the permitting process has been long and dragged out, but the company says it's probably that they don't see it commercially viable until year-end 26, beginning of 27. Now, the next facility that's probably in line is Energy Transfer's Blue Marlin facility. This is an interesting facility because as far as from a construction standpoint, this one can probably be brought on the quickest. They're leveraging existing gas infrastructure that's in the ground to provide the liquids connection to the platform that would eventually be constructed. Now, the way that we see this playing out really is if one or multiple of these facilities get done, you're probably at risk of seeing some of these inner harbor facilities volumes displaced as these offshore facilities become a magnet for that. So there could be a little bit of cannibalization of volumes for Enterprise-owned facilities that are located in Freeport and Texas and the Houston Ship Channel. So this isn't a great transition, but we're going to move on to Canada real quick. Like I said at the beginning of this, really what's going on in Canada is the biggest thing to help the biggest change to North American crude pipeline infrastructure since we overbuilt the Permian. So just a brief overview of demand and supply out of Canada. That bottom left graph is taken from our Crude Hub Model. That looks at the disposition of WCSB production and imports to the various regions in the U.S. and the Canadian West Coast. We send more than a third of our production right now to the Patoka. It's imported into Patoka or PADD 2, and that makes its way either into the U.S. mid-continent refiners or shipped into Eastern Canada, or as well goes into the Cushing and U.S. Gulf Coast markets. Now, the Canadian pipeline takeaway has historically been constrained, which has put pressure on the WCS differential. Sometimes it's traded as much as $50 behind WTI when things get really tight. And in order to clear excess supply, we really had to rely on railing, sometimes as much as 400,000 barrels a day. Now, Enbridge has expanded their Line 3 replacement program, which added a little bit of capacity at the end of 21. However, the market was still tight based on our supply and demand model. We won't become completely unconstrained or debottlenecked until Trans Mountain comes online sometime in the first quarter of this year, crossing our fingers. Just to give you an idea of how constrained it's been, this is data that's taken from our Crude Hub Model, as well as data published by the Canadian Energy Regulator of nominations versus volumes. So this just goes to show that there's more barrels that have wanted to get on pipes than what capacity is available. And if you look at that bottom left graph, just to call to attention how this price has reacted to this utilization or this high utilization rate, you can see WCS pricing is, been about $20 back or so from WTI. Now, the Enbridge mainline is the only pipeline that works on a completely nominations basis. So you have no committed shippers here. There are some quasi commitments here through the international joint tariff, but for the most part, you have no international shipment or no committed shippers. So you have to nominate on a monthly basis to get your allocated pipeline space. Pipes like Keystone, Trans Mountain, these pipes have high levels of commitments. So they have finite or very little uncommitted space, which is why you kind of will see, especially with Keystone, where you have these months of large nominations that greatly exceed the supply in Western Canada. Now, if I were to extend the y-axis all the way on the Keystone pipeline, you'd see this hit 7 million barrels a day. Now, the reason that we see that happening is because shippers are basically over-nominating to try to get their apportionment volume as close to the original barrel as they, or the original volume that they wanted to ship. Once Trans Mountain comes online, we probably see these numbers dropping back down significantly. So this is the project. This is what's going to debottleneck Canada. This is the Trans Mountain pipeline expansion. Goes along the same right of way as the existing pipeline. It's supposed to be operationally complete sometime, coming up in the next few months. However, we have seen in the news recently that they're facing challenges about I think it's just over a 1 kilometer section of the pipeline that they need to resolve. Currently, we have the pipeline coming into service in the first quarter of 2024, which aligns with what the company has been saying. Now, the pipeline does have a significant level of commitments, about 470,000 barrels a day based on our modeling. This is across 11 shippers, some U.S., two Chinese companies, and the balance held by Canadian producers. Shipping along this corridor is going to give you access to the Vancouver and U.S. Pacific Northwest or West Coast refining market, as well as the optionality to load onto a ship to head over to Asia. Now, early on, once these barrels start to flow, we expect many of them will probably stay in the domestic or North American market, meaning we don't expect a huge uptick in shipments. And the reason for that, as I call back to your attention of the things that Christy went over, is where you look at Russia has basically been supplying or been a cheap supplier of crude to those Asia Pacific economies. Now, overall, we do expect the volumes to go about 50,000 barrels over their commitment level, so about 525,000 barrels by January of 2025. Now, we just updated our forecast, so the numbers are going to be a little bit different if you look in our new Crude Hub Model, which is going to come out either today or tomorrow. But in general, the waterfall of how we see volumes being displaced is pretty much the same. Really, Enbridge Mainline, from a notional standpoint, has the largest volume risk. As the pipeline is the biggest pipeline out of the basin by capacity, we expect somewhere between 210 to 260,000 barrels a day coming off that pipeline. Keystone, we expect these probably drop back down to their commitment levels, so that's only 45,000 barrels a day. And then Express is at risk to lose some, which is a pipe that feeds into the Montana, Rockies, Guernsey area. Additionally, we see less of a need for rail as we expect the WCS diff to really tighten up or to tighten up a little bit relative to WTI, making economics less needed. Now, the last thing I would like to touch on really is just the scope of the project. This TMX was supposed to come online 5 years ago at a cost of about $7 billion when KMI owned it. So flash forward to today, the Canadian government has purchased that from KMI in the best game of hot potato ever. And the cost is now 4 times what was originally planned, and it's upwards of 30 billion Canadian dollars now. Now, what does that mean for shipping economics? Well, the rates have vastly changed on this pipeline. The current legacy line to ship a barrel from Edmonton all the way to the West Coast is about $3. So in order to recoup all the cost overruns that this project has faced, tariff rates will have to be restructured. A result of the restructure, the proposed restructuring of tariff rates that was submitted by Trans Mountain to the CER shows rates that are about 3 times the current tariff rate. And why is that interesting? Well, because if you look in that middle bottom graph of the comparative rates of egress pipelines, you can see that this puts it in direct competition with other egress pipelines out of the basin to ship a barrel all the way to the U.S. Gulf Coast, which is a route that is almost 3 times the length. So just to touch briefly on what we went over today, first and foremost, the global economy is going to drive what we see as far as the implications for demand and global crude oil balances. But there are reasons out there, structural reasons out there, why we see oil prices are heading higher, or at least going to be pretty resilient. And that ties to the demand growth that we see, whether that's from the DOE repurchasing U.S. produced barrels for the SPR, or growth from emerging international economies like Christy talked about. The other thing is shrinking global supply. OPEC's commitment to keep balances tight and price stability is evident. We expect them to maintain the cuts currently. And then, on the U.S. side, U.S. producers, they've been stressing capital discipline, higher payout ratios. This has led to tight balances here at a time when we're historically low as far as a crude stocks perspective. Then, just briefly touching on Canada, that's going to have implications as far as U.S. crude balances go. There's going to be about 500,000 barrels of oil that will be displaced that's currently going into the U.S., either that on Enbridge Mainline, Keystone, or Express. That will impact U.S. balances, particularly what's going on for the U.S. Gulf Coast refiners who have access to that cheap Western heavy sour. And then lastly, it's really the U.S. export facilities and their ability to facilitate all this growth and meet the growing international demand, whether that be through the existing facilities that we have at Ingleside that can load very big ships, or through 1 or 2 of these offshore facilities that are newly proposed off the coast of Houston and Corpus Christi. So that is the end of our presentation. We're going to pause for a minute to collect some questions. I invite you to sign up for the Crude Edge newsletter. You can do that by scanning the QR code there or clicking the link. That'll take you to the East Daily website where you can get signed up for that. Our first iteration, our first publication of that will be on September 5th. Okay, we have a couple of questions. The first one is on production response as far as in Canada once TMX is online. Christy, do you want to take that?
Yeah, I'll take that. We, Canada has never, in the last 10 years, had much egress. So one would think that production would be very robust now that they have egress. But when you look at the forecast, specifically the Canadian energy, regulator, their production is forecasted to grow, but not nearly as robust as you would think. It's a little bit more mild. We do have that built into our forecast, and it is surprising.
Thanks, Christy. It looks like we have a few questions on TMX. One question is anecdotally heard that volumes could be lower than 500,000 barrels a day due to economic shipping costs on TMX versus Enbridge. Yeah, so just high level, I mean, there are 470,000 barrels of take or pay commitments that are underpinning this pipeline. So that is what we see is the bottom as far as what volumes are going to do on TMX, because shippers are already signed up for those rates. They're going to pay for that capacity whether they use it or not. Now, as far as the economics go, yes, you know, obviously with a competitive tariff with Keystone and Enbridge Mainline, Trans Mountain becomes a little bit more of a head scratcher. However, typically what we see is stronger pricing for crude oil on the West Coast, whether that, you know, I don't know the exact marker that you would use. You probably have to use more of an Asian sour and take out transport, which could lead to a higher netback probably than what you're going to get along the U.S. Gulf Coast. One question about the presentation. Sorry if I did not say that at the beginning. The presentation materials will be available for download after this, as well as a live or a replay recording. I believe we post it to YouTube. One thing that we didn't talk about, and one question that we got, is really about the heavy crude balances in the U.S. Gulf Coast. So with the impacts of TMX kind of pulling away those barrels that have been imported into the U.S., either in PADD 2, they're all the way down to the refiners in the Louisiana and Houston area. That is going to pull away some supply, which is predominantly a refining barrel that those refiners have been using. Now, how does the market balance from that? Well, we see that as possibly a call on Gulf of Mexico production, really. Can the Gulf of Mexico backfill? Do we have enough capacity to basically backfill what's being displaced by TMX? There's one question that's on physical versus emotional market, as far as how do we look at the physical market, supply, demand, refining capacity versus the emotional market, which I think is more based on our forecast or sentiment, geopolitics, and other traders. So I would say that, you know, we leverage a lot of the data sources that are available to us to monitor the physical market and as close to real time as we can get. Unfortunately, that means using the Texas Railroad Commission data or the Louisiana data, you know, FERC, CER, really to monitor what pipeline volumes are physically moving through these pipes, as well as what's physically going into the refineries. So I think from a today backward look, we have a pretty good grasp on what kind of the physical market is doing as far as the movement of oil in and around North America. Now, for the forward market, the way that we try to think about that is we take a very methodical approach to doing that. And the way that we do that is we really look at our data on as far as commitments go. Who are the shippers that have historically been feeding this? Are they going to the preferred destinations? And then what is pricing like at those destinations? Now, what we don't account for is our Crude Hub model is really kind of infrastructure as is model. You'll notice that, you know, we didn't have any of those expansions that are built into, you know, the Corpus Christi shipping corridor or any other pipeline expansions that are unannounced. But we can run scenario analysis for that. Hopefully that answered your question. With that, I think we're going to end it here. I'd like to thank everybody for joining us today. We will be sending out the materials and a replay of the presentation later today. Thank you.
Thank you. Bye-bye.